I do think we are in the early stages of an economic recession and bear market. I think the rally we've seen over the past month is indeed a bear market rally. It's driven primarily by short covering. But I mean, there's two, at least two, if not three major indicators I've been paying very close attention to for months now. The thing I follow probably most closely is insider activity, just executive buying and selling in the stock market. And the reason this indicator on a macro level is so important is that the overall sell to buy ratio, when you average it over a 12-month period, leads the stock market and the economy by 12 to 24 months. And so when you see insiders buying heavily, that's really a good sign for the stock market over the next 1 to 2 years. And it's also a really good sign for the economy that the executives are very confident in what the outlook for earnings and things looks like. Insider activity got about as bearish as I have ever seen it late last year. So mid to 2021 to late last year, we saw the sell to buy ratio on a 12-month basis go over 30, which is huge. I mean, normally 20 is pretty high. You get down to 10 is pretty bullish. We were just off the charts bearish last year. And that's a pretty good sign that the stock market and the economy over the next 12 to 24 months are going to be a lot weaker than people anticipate. We've seen that, right, with economic slowdown, and we've seen it with the stock market action so far this year. But there's another, I think, more fundamental macro indicator that validates the view that insiders were telling us, 6 to 9 months ago. And that's when you get a rising dollar, rising interest rates, rising oil prices, that is a very bearish trifecta for the economy and for corporate earnings. That's another one that leads by 12 to 24 months. And we've seen all three of these things for the last 2 years just rip higher. Obviously, interest rates bottomed in early to mid 2020 and have been rapidly rising. Oil prices went negative, right, and went over $100 a barrel. That's a huge reversal. And the dollar weakened significantly when the Fed started its money printing in 2020 and has been much stronger. So those three headwinds are a pretty good leading indicator of manufacturing activity. A lot, all the standard kind of things you see, and were very supportive when they declined so significantly into the early days of the pandemic. That created a very strong fundamental tailwind for the economy and earnings over the past 2 years since they declined. Now those have all turned very bearish for both the economy and corporate earnings. So I think those are things that are telling me that it's time to be very cautious towards risk assets and the economy in general.
And I want to just ask back to your insider activity statistics there. You said it was about the most bearish you'd ever seen at the end of last year, and this year seems to be proving that out. Where is it currently standing right now? Has it improved at all? Is it still bearish?
It's a great question, right? So I follow two metrics, really, the 12-month average and a 12-week average. So the 12-week average has actually, in mid-June to July, started getting pretty bullish, where we saw it get down to about 5 times. That's the 5 times the dollar value of sales versus buys. So that was kind of a short-term, very bullish indicator. And pairing that with the amount of extreme positioning on the short side, right? We still see it. And it's one of the concerns, I think, for the bear case right now, is you see extreme positioning on the short side, which created the potential for the type of short squeeze we've seen over the past month. But yeah, insiders have gotten pretty bullish over the short run. But at the same time, that long-term measure is still at about 16, 17 times sales to buys. So that's still not come down to a level that is typically bullish for a 12 to 24-month time frame. So I think the short-term measure is saying, yes, it was pointing to we could have seen a rally here. We did. But the long-term measure is still saying we're not at a good point where it's safe to start buying risk assets on a longer-term time frame.
Okay, so first off, this makes total sense, right? I mean, the captains of industry are the best ones to know what's happening out on the economic ocean, if I can murder that analogy here. But these are the guys that are running the companies. They're the closest to the heartbeat of the global economy. They're likely to know better than anybody else where things are likely heading, right? So they got real pessimistic. You said it's become more bullish in the nearer term here. Has it become more bullish, or has it just become less bearish? Because it sounds like you said it's still sales are still higher than buys right now, even on that shorter time frame. Did I hear you correctly?
Yeah, and I think it's really important to point out, a lot of people like to look at this from a macro perspective without kind of parsing the data to understand where is the buying happening, where is the selling happening. One of the most bearish things that I've seen this year is even in April, we still saw a significant amount of insider selling in the tech sector. That's very bearish. When you see prices fall 50% and insiders are still selling, that's not a good sign. That's very worrisome. And that was one of the things that kind of marked the insider activity. By the same token, we've still seen significant insider buying. To the extent there has been buying, it's been in the energy sector. We've seen significant buying as oil prices have pulled back, and especially in kind of like the pipeline and infrastructure stocks. I've just seen consistent buying there for 2 years, really since the fall of 2020. Energy insiders have been very, very bullish. And so you can use this stuff from a macro perspective, but it's also, I think, important to kind of dial down to the micro level and see where is the insider buying and selling. And earnings kind of bear this out, right? Energy is really the only bright spot in corporate earnings right now, whereas every other sector looks like we're entering an earnings recession. It's just energy that's kind of holding up the whole put together the earnings picture. So I do think it did in the short run get to a macro bearish or macro bullish picture, but that's really just kind of more of a short-term trading perspective, doesn't speak to the longer term process. And that's really what I think most investors are most interested in, is when do we get to that point where it looks like the bear market's over, it's safe to get back into the pool again for a long-term buying opportunity.
Yeah, well, so two things. One, let's earmark that energy discussion for later on in this conversation when we get to areas of opportunity, because you've written some really interesting recent data on that. Secondly, what I think I hear you saying is even though insiders have become less bearish in the near term here, and of course you got to be careful to see where they're buying and where they're selling, as you said, I don't hear you saying this is the bell that marks the bottom, right? That this is probably more short-term, maybe even more tactical to a certain extent. And you mentioned earlier at your intro that you felt like this bear market, we're in the early stages of it, which implies you think it's things are going to head down further from here. Am I just capturing your general outlook here?
Absolutely, yeah. Yeah, and I think the reason for this is I think, and there's a reason why you have classic bear market rallies, or these rip your face off type rallies, because sentiment changes much more rapidly than the fundamental picture, right? I think it's very clear that we're entering an earnings recession, but people came around to that idea and expected second quarter earnings to be terrible. When they weren't terrible, right? All those people that were buying, I mean, the activity in SQQ or SQQQ, the leveraged short NASDAQ 100 ETF was just massive. It was basically the mirror image of what we saw in TQQQ last year. I mean, the interest in these leveraged ETFs is just astounding. We saw retail investors get massively bullish last year, buying tons of call options and all these things. And in June, we saw them switch to buying put options and buying leveraged short ETFs. And then in the futures market, you saw a massive short position. So I think sentiment just got too bearish, and fundamentals, haven't really declined to the point to validate that bearishness. And so you see the short covering rally that we've had over the past month or so.
If you enjoyed this video clip, click here to watch another one you should like.